The US tech hiring freeze didn't arrive with a crash, a headline panic, or a single dramatic announcement. It showed up quietly. Fewer job posts, longer interview cycles, roles that get paused at the final stage, recruiters going silent. And yet, almost no one in the industry wants to call it what it looks like from the outside: a recession-like slowdown in tech hiring. This is the US tech hiring freeze nobody wants to call a recession. And understanding why companies are behaving this way matters far beyond Silicon Valley. What makes this moment unusual is that tech companies are still profitable. Revenues are not collapsing across the board. AI investment is booming. Stock prices for many large firms are near highs. And yet hiring has slowed to a crawl. That contradiction is the key to what's really happening. This isn't a demand problem, it's a confidence problem. For most of the last decade, US tech hiring followed a simple logic. Growth came first. Talent was insurance. You hired ahead of demand, built teams early, and trusted that future revenue would justify today's payroll. That logic worked in a zero-rate world where capital was cheap and mistakes were forgiven. That world is gone. Today's hiring freeze is driven by a fundamental shift in how risk is priced. Boards, CFOs, and investors no longer view headcount as a flexible cost. They see it as a long-term liability that's hard to unwind without reputational damage, morale collapse, and regulatory risk. Every new hire is treated like a multi-year capital commitment, not a short-term expense. That mindset alone explains why job openings have fallen even at companies posting solid earnings. Another reason this hiring freeze feels invisible is because it's uneven. Layoffs made headlines in earlier years. Hiring freezes don't. Companies simply stop replacing attrition. They leave roles unfilled. They consolidate responsibilities. They move work to contractors or overseas teams quietly. From the outside, the company looks stable. Inside, teams feel stretched and cautious. Executives avoid the word recession because traditional recession signals aren't present. Consumers are still spending. Enterprise clients are still renewing contracts. But internally, leadership teams are planning as if demand could soften at any moment. And that uncertainty is enough to freeze hiring decisions. The US tech hiring freeze is also being reinforced by AI in a very specific way. While AI investment is accelerating, it is changing the type of hiring companies are willing to do. Firms are prioritizing a narrow band of high-impact roles while cutting or freezing generalist positions. Instead of hiring 5 mid-level employees, companies would rather hire 1 senior engineer and add automation around them. This creates the illusion of hiring activity while total headcount stays flat or declines. At the same time, productivity expectations have shifted. Post-layoff, many teams proved they could maintain output with fewer people, at least in the short term. That changed internal benchmarks. When a manager asks for approval to hire, the immediate question is no longer, "Do you need help?" but "Why can't your team handle this with existing resources?" That question is devastating for hiring momentum. Another driver of this freeze is memory. Corporate America remembers how fast tech hiring reversed last time. Executives who overhired during the boom years faced public layoffs, investor backlash, and internal trust erosion. That experience has made leaders deeply allergic to being too early again. So instead of hiring ahead of growth, companies are demanding proof. Proof that demand is durable. Proof that revenue is locked in. Proof that the role will still matter 18 months from now. Until that proof exists, hiring stays frozen. This is why calling it a recession feels inaccurate to executives, but accurate to workers. From a macro perspective, the economy isn't contracting sharply. From a labor perspective, opportunity has narrowed dramatically. The result is a psychological recession for tech workers, even if GDP says otherwise. The freeze also reflects a deeper structural shift in how tech companies view scale. For years, scale meant headcount. Bigger teams signaled ambition. Now scale means leverage. Companies want systems that grow revenue without growing payroll. That philosophy naturally suppresses hiring, even during good times. Importantly, this hiring freeze is not temporary in the way past slowdowns were. It's not just about waiting for interest rates to fall or markets to stabilize. It's about rewriting the internal rules of growth, and once those rules change, they rarely snap back quickly. The ripple effects are already visible. Early career talent is struggling to enter the industry. Mid-level professionals are stuck competing for fewer roles. Compensation growth has slowed. Job security has become a top concern again. All of this feeds back into consumer behavior, reinforcing caution across the economy. Yet publicly, companies remain optimistic. They talk about efficiency, focus, and long-term strategy. They avoid words like freeze, slowdown, or contraction, because saying those words invites questions from investors that no one wants to answer. That silence is what makes this hiring freeze so powerful. It doesn't announce itself. It just quietly reshapes the labor market. The US tech hiring freeze nobody wants to call a recession is ultimately about control. Control over costs, control over expectations, control over narrative. Companies would rather appear disciplined than aggressive, stable rather than ambitious. And until confidence fully returns, not just in markets but in predictability, hiring will remain cautious no matter how strong the headlines look. This is not a collapse. It's not a boom either. It's a long pause. And for anyone watching the tech labor market closely, that pause says more about the future of the industry than any earnings report ever could.